Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, welcome back to The Explainer, everyone. Today, we are putting a global industrial giant under the microscope to uncover exactly how a massive corporation navigates extreme, unforeseen geopolitical headwinds. We are acting as investigative journalists of their financial statements today, looking specifically at Tenaris in the year 2026. This was a year that totally stress-tested their operations, their balance sheet, and their leadership. It's an absolutely fascinating look at corporate resilience in real time, and we've got the hard data to map out exactly what happened.
Okay, let's dive right into this. The core question we're answering today is this: how does a global steel giant survive and actually manage to reward its investors when a major world trade route effectively shuts down? Global supply chains are, frankly, incredibly delicate. And when you're shipping heavy industrial products all around the world, logistics are literally everything. Extreme disruptions test corporate armor like absolutely nothing else.
To make sense of the financial filings, here's our roadmap for today. First, a solid foundation. Second, rewarding leadership. Third, the geopolitical storm. Fourth, financial impact unpacked. And finally, the investor's perspective.
Section 1. A solid foundation.
So to understand the impact of a macro crisis, you first have to understand where a company stood right before the storm hit. For those of you who might need a quick refresher, Tenaris is a massive global supplier of steel pipes and related services, mostly for the energy industry. We're talking about huge operations in North and South America, Europe, the Middle East, and beyond. Because they're a heavy-hitting industrial manufacturer, they rely heavily on smooth, predictable global shipping and raw material availability.
And heading into 2026, Tenaris had some serious momentum. Let's dig into their 2025 baseline achievements based on their actual filings. From a purely financial standpoint, they boasted the highest EBITDA margin and the best net debt to EBITDAre ratio among their entire peer group. But their ESG metrics were equally stellar. They completed their 94.5 megawatt La Rinconada wind farm completely on time and on budget. And this is critical for a heavy industrial manufacturer. They recorded absolutely zero workplace fatalities in 2025.
Section 2. Rewarding leadership.
Now, as an equity researcher, I always look at how corporate success at this scale trickles up to the executive suite. What's really interesting here is the final payout. For the 2025 fiscal year, the board approved a total compensation package of $10 million for Chief Executive Officer Paulo Roca. That is a massive number, sure, but the compensation report actually notes that the risk-adjusted median for total CEO compensation in their peer group was even higher, sitting around $11.5 million.
Let's break down that payout a bit further. That $10 million wasn't just a flat guaranteed salary. It was split into a $3 million base salary, paid out monthly, and a massive $7 million performance bonus. So why the hefty bonus? Well, the board's report specifically cited those exact achievements we just looked at: maintaining the highest EBITDA margin in the sector, generating strong free cash flow, and directly addressing safety by achieving zero fatalities. It was a direct reward for building that incredibly sturdy financial foundation.
Section 3. The geopolitical storm.
But here's the reality check. A sturdy foundation can only protect you so much when the macroeconomic environment suddenly flips upside down. Let's walk through this timeline together. In late 2025, as we saw, Tenaris is in a very strong position. But in March 2026, a major geopolitical event occurs, creating massive global disruptions. When May rolls around and Tenaris reports their Q1 earnings, they actually look quite resilient, mainly because the disruption happened so late in the quarter. But by August 2026, when Q2 earnings drop, the logistical hit becomes completely undeniable.
So what exactly was the macro event? In March 2026, conflict involving Iran led to severe disruptions in the Middle East, crucially including the closure of the Strait of Hormuz. Now, for a global industrial supplier shipping heavy steel pipes, the closure of one of the world's most vital maritime choke points is an absolute logistical nightmare. You have to change your routes, shipping takes way longer, and costs absolutely skyrocket.
Section 4. Financial impact unpacked. So as an investor, you have to ask, how did that actually translate to the balance sheet? We're going to zoom in from world events to the micro financial numbers. Look at the shift from the first quarter to the second quarter of 2026.
Net sales dropped 4% sequentially, going from $3.1 billion down to roughly $2.96 billion. But the real hit, that was to profitability. Net income dropped 13% sequentially, falling from $564 million in Q1 down to $492 million in Q2.
Why the stark difference between the two quarters? Well, Q1 was buoyed by some very specific favorable drivers that masked the pain. They had seasonally higher activity in Canada, and customers in North Africa were actively building up their stock. But by Q2, the brutal logistical reality of the closed Strait of Hormuz fully set in. The company specifically cited higher unitary logistics costs, a lower absorption of fixed costs, and rising raw material costs as the primary drags on their operating income. Selling, general, and administrative expenses jumped up as a percentage of sales, and that was largely driven by those increased freight and shipping fees.
But remember that solid foundation we talked about earlier? Here is exactly where it pays off. Despite the margin squeeze in Q2, Tenaris ended June 2026 with a net cash position of $3.6 billion. Let me repeat that, $3.6 billion. That is an incredibly thick layer of financial armor. It allows them to weather this exact kind of logistical storm without panicking or having to fire sale assets. Section 5. The investor's perspective.
That massive cash pile leads us perfectly into how the market interpreted all this volatility. Let's look at their price-to-earnings ratio, or PE. At the end of 2024, it sat at 10.2. At the end of 2025, when things were absolutely stellar, it was 10.4. But by August 2026, looking at the trailing 12 months, the PE ratio actually expanded to 13.9. What this tells us is that while earnings have taken a hit due to the logistical costs, the market hasn't abandoned the stock. In fact, the valuation multiple expanded. This shows a real change in the market's expectations, perhaps pricing in a future recovery once the dust settles.
So the crucial point here is this. Tenaris isn't just hoarding that $3.6 billion in cash under a mattress. They are actively returning it to investors, even while their margins are under extreme pressure. In May of 2026, right as the logistics hit was happening, they paid out a massive $606 million dividend. On top of that, they executed $90 million in share buybacks during the first half of the year.
All of that cash return resulted in a very healthy 5.2% dividend yield at the time. For income-focused retail investors, that is a highly attractive takeaway. It essentially proves that management remains committed to shareholder returns, drawing on that solid balance sheet even when the macro environment gets incredibly tough.
But what about the future? Well, according to industry reporting from Steel Orbis, Tenaris has a pretty clear view of what comes next. The quote reads, "For the second half of 2026, the company foresees its sales and margins to recover, assuming the Strait of Hormuz is reopened in the short term. They know exactly what the drag on their business is, and they're openly communicating to the market what needs to happen for a bounce back."
Which leaves us with this final thought. We've seen how a rock-solid balance sheet can protect a company through a sudden logistical nightmare. But will these vital global trade routes reopen soon, allowing margins to recover? Or is this heightened, expensive, rerouted supply chain just the new normal that industrial giants are going to have to get used to? The models and fundamentals might point one way, but macro flags suggest a storm. Which side are you on? Keep doing your own homework on global supply chains because it affects the bottom line of almost everything we touch. Thanks for joining me on this case study, and I'll catch you on the next explainer.